Hello and welcome, everybody. Happy Friday. Welcome to the end of a 4-day week, a positive day in the market, and another Sectors Made Simple webinar. Today, I'm bringing you all a topic that was requested by a Sectors Made Simple subscriber. They heard a lot of conversation about 3 letters that they weren't really sure what it meant, and they wanted to have a little bit more information about what DRS is and also what these monkeys in the market are, these apes as they're called. So today I want to try and demystify some of that. I want to talk about DRS, what it is, how the apes fit into all of this, and it's going to be a little bit of a history lesson as much as it is going to be an informational webinar. So I hope you all are ready for some story time as we look over the history of stock ownership, what owning a stock really means, how owning a stock in 2022 works, and also how DRS fits into all of it. So let's get straight into the action. So today's webinar is all about DRS, which stands for Direct Registration System. Disclaimer, today is not as important, but it's always here. Whenever I'm talking about investment topics or talking about trading strategies, anything like that, everything that I share is meant to be educational. It is not meant to be a go use this strategy, you'll make $1 million. Anyone that tells you you'll make $1 million with a strategy, run. Past results can never guarantee future performance, and doing your own research, understanding why you're trading the way you're trading, or in this case, why you're taking action with your shares, is very, very important. So today, I'm not going to sit here and tell you, go DRS your shares today. Instead, I'm going to teach you a little bit about what it is and then let you make the decision of how to approach it if you wish to at all. So the goals for today's webinar are that we're going to talk about DRS. This direct registration system has become a very popular topic over the past year, but especially in the past few months where it's gained a lot of attention on different social media sites such as Reddit and Twitter. So today we're going to cover the basics of what DRS is, and we'll also look at some of the events and reasons that have led up to why DRS is so popular of a topic in today's market. And then lastly, we'll answer the question, should you care? Is this something you should be thinking about, worrying about, and ultimately going through the process of setting up? So let's get into it. Before we talk about DRS, which is the informational side of all of this, we have to do a little bit of storytelling. So let's talk about what exactly a share is, and more importantly, how share ownership works. And to do this, we're going to go back in time, not too far honestly, just back before the days of the internet. Because back before the days of the internet, when a buyer, an investor, let's say, purchases a share, they were given a physical certificate confirming the share's ownership. So when you go and purchase a share, they would give you a big piece of paper that has the information or like the serial number of that share, and then also it's gonna have, a nice piece of paper showing you this represents one share of this company. It was issued on this date, and it's going to be your ownership of that company. So even into today's age, where we have access to the internet and online brokers, some companies would still issue illustrated shares. Now, I have Disney here as a specific example, because Disney was a company that was extremely popular for issuing physical shares. The reason? They had a fascination or an interest in having these shares not just be a representation of ownership. It didn't just tell you you own Disney. It's something beautiful. It's a piece of art. So these shares were issued by Disney up through 2013. And to kind of show you a little bit of what I mean, here's an example of one of those Disney shares. It's not just a confirmation of ownership. Instead, What it is it's got illustrations. It's got characters from different Disney movies and TV shows. It was something that was meant to be, yes, a investment, but also be a piece of art. Many people, including myself, have shares like this framed and put up on our walls because it's pretty. They are not just an investment. So when you're looking at this, there's a couple of different things going on. One, common stock telling us it's common versus preferred. The CUSIP, which is essentially the serial number for that share. And then when this share was actually issued. So in this case, November something of 2003. And again, before the days of the internet, this wasn't just a cool thing to put up on your wall. This was how shares were distributed. And if you, for example, lost it, if it got destroyed, or if it got stolen, proving ownership of that share becomes very difficult and raised a lot of concerns for many investors. But even if you didn't lose it, it still brings up a little bit of a question. How would you sell these physical pieces of paper? Blaze says it almost looks like a certificate. It is. It is quite literally called a certificate. So, great word. When a shareholder goes to sell that share, what they would need to do is take the piece of paper, if it's in a frame, take it out of the frame, and mail it back to the broker or a transfer agent. We're going to talk about this word transfer agent quite a bit today. These transfer agents are representatives for these companies. A public company doesn't want to have to deal with who owns what shares. They just want to do their business and then say, all right, here's the common stock, here's the preferred stock, here's dividends, here's financials. That's all they want to do. So instead, they have transfer agents such as ComputerShare to actually handle all of these interactions between the company and public investments or public investors. So when a shareholder before the days of the internet would go and sell their share, they would need to mail that certificate of ownership back to the broker or to the transfer agent, whoever is facilitating that trade. And obviously, mailing something is slower. Before the days of airmail, it was extremely slow, and trades would take a very, very long time to clear. Much longer than the T+2 that we have now, where if a trade is started on one day, 2 days later, that trade will settle or complete. So that's part of the reason why we've moved away from these shares. They're cool, but it's really annoying to have ownership be in a physical form. Anyone that was an early investor in Bitcoin or cryptocurrencies and lost their wallet, it's not just losing your wallet like you left it out in a park or something like that. If you lose a wallet or if you forget the password to it, you might be completely out of luck with ever getting those funds back. Shares weren't very different, where physical ownership of this share mattered. So if you lost ownership of it, proving ownership that you own that company becomes a little bit trickier. Not impossible, but a lot tougher. So let's now ask the question. I just showed you a share that was issued here in 2003. The computers in investing and in the stock market world have been around since the late 90s. Why are there still physical shares today? And better yet, why in 2022 would investors want to have physical shares? Because, well, Disney was the big example of a company that stopped issuing physical shares. Many companies still do. Many companies and brokers will give you the option of having physical certificates to verify and to confirm your ownership. It is not the only way to confirm ownership, but it is a nice physical representation of what you own. And the biggest reason is not an investment one. It is not a money one. It's art. Or, in some cases, the meaning behind that share. For many people, they look at stock ownership as an investment. But many people also invest in companies they care about. And if you care about a company, you want to show that off a little bit. That's why people put up different logos and posters on their walls. They want to show their love, dedication, or fandom to these different organizations. Musicians, yes. Movies, probably. But also companies as well. I'm going to give you an example. When I was probably around 4 or 5, I was very small. My mom purchased me a share of Pixar. This was before Pixar was acquired by Disney, so Pixar was its own publicly traded company. And she bought me a share of Pixar and bought the physical certificate, had it framed, and I still have it upstairs. And it looked something a little like this. And it was beautiful. It didn't just represent an investment asset. I never looked at it as, oh, when I get older, I'm going to go and I'm going to sell that share of Pixar and turn a profit. The value to me, in the sentimental value, what it meant to me was a lot more than what anyone would be willing to buy it for in an open market or a stock exchange. So, I still have it. And I'm not the only one that feels like this. So, especially for kids, people that, they're not actively investing to help save for retirement or to contribute to a student's college fund. Instead, they're just buying it because it's a work of art and it represents someone's first investment in many cases. This was the first stock I ever owned, was this share of Pixar. So to me, it mattered a lot more for what the value was personally than the value of what that share could sell for on the stock market. So let's now answer this question. Can you still buy physical certificates or physical shares today? Yeah. Yes, you can, but only sometimes. Not all companies will offer the ability to go through them or through their trade partners and actually buy a share. So some companies definitely do, and many companies do. Either directly through them or through their transfer agent, you can go and purchase physical shares. Also, brokers will allow you to get physical shares of many companies, but they charge you for it. And for example, I only looked at Fidelity when I was preparing this webinar. Fidelity's price for getting a physical certificate of a company, $100 per certificate. So it is not cheap. But there are also third-party companies, I'll say right now, not sponsored by them. I did a Google search, and also one of these is the company that my mom used to buy me my share of Pixar years ago, which is the one that she bought me the share through was Give a Share. And another one that I found that's extremely common is Unique Stock Gift. I'm just going to go to, again, no preference here or no opinion. This is just me wanting to literally Google something and help you start off a search if you're curious. Let's go and look at Unique Stock Gifts, and we can see some of the shares that you can buy. So let's look. There are different sectors, so let's go to tech. Why not? I like technology. Here are many different companies that through their program will allow you to buy a physical share of that company. Funny enough, for Meta, it still says Facebook. Kind of silly, but in addition to these stocks, yes, you also pay that transfer fee here. It's not like going through them saves you that fee. You can get a stock certificate, and they'll frame it for you and put a nice little plaque on it. And they're pretty. They're really cool. And again, the value here is not just in the share, but it's in giving someone their first step into investing. Because for me, that's what that share of Pixar represented. It was my first stock ownership. So again, there are hundreds of companies that you can look at here that would allow you to get a physical certificate confirming your ownership. And that physical certificate you can give to someone as a gift, stick it on a wall, and have it as a piece of art. But let's get away from all of that now, and let's instead now look at how stock trading works today. So, how does it actually work? Well, when you purchase shares through a stockbroker, like Fidelity, Robinhood, whatever it might be, what they'll do is they'll take your money and go out and buy the shares. And then they'll keep the shares in a big pool of other shares owned by other investors. Now, before we get too far into this, I need to make a distinction here. If you own a cash trading account, what I'm about to say does not impact you at all. If you own a margin account, there is a very high likelihood that when you were going through creating that account and hitting accept on all those sheets of paper or signing all the sheets of paper, you didn't pay attention to what each one of those said. You didn't read them in full detail. And there's a oh my gosh, that's an annoying word to say. Hypothecation agreement that is a part of setting up a margin account, that if you agreed to that, will allow your broker to lend out the shares that you have purchased through that margin account to other investors. So, especially with a margin account, when you own shares, it gets pooled in with other investors, but also the broker can lend out your shares from that margin account. Now, again, does this really impact you at all? Does this change your ownership of it? No. But what it does is it lumps you into a big group. And I'll show you a graphic in a couple of minutes here to explain this in a little bit more detail. Actually, I'm just going to show it right now, and then we'll look at it again later. When you own a share, you are not listed as a shareholder. Instead, what happens is there's the shares that are available, the outstanding shares. Then, when you purchase a share, it is purchased through a broker. That broker is not the first person in this big chain. Instead, there is a category called beneficially owned shares, which then works its way down to the DTC, which is going to be an organization called the Depository Trust Committee, that then goes down to the banks and brokers, and then lastly to you. So the broker keeps track of who owns how many shares within that brokerage. But if you look at the registered owners for a company, it won't list your name. Instead, it will list that bank or broker, or more realistically, it'll just list the DTC nominee that is representing that bank or broker. So there's a couple of orders of magnitude separation between you actually being a shareholder. Yes, you still get to vote, but you're not listed as an owner of those shares. So again, we'll come back to this in a little bit, but I just wanted to show this as a visual example to explain why all of this really comes to be. And again, should you care? Is this a problem? No. It's not a problem. It doesn't change your ownership. It doesn't change if your shares are insured, if the broker goes under. None of that really changes. So either way, if you decide that you want to buy or sell shares of a company, the biggest risk is not in the broker going under. It's not the broker losing their liquidity and going under or declaring bankruptcy and you losing your shares. The bigger risk is that a broker can't or won't complete your trades. This sounds weird. Their job is to facilitate trades for us. Their job is to help us to be buyers and find sellers, or to be sellers and find buyers. Now, what happens when they stop doing their job or can't do their job? And more importantly, does this happen? Well, it did last year in January. The company that that was at the center of it all, Gamestop, along with a few other companies like BlackBerry and AMC. And the broker, Robinhood. Elizabeth's asking, what about my drips that I'm planning on owning 50% of the company? So are you talking about a publicly traded company that you own 50% of? That would be millions upon millions upon millions of dollars. I'm sorry, I'm not really sure I understand the question. My apologies. Okay. You're planning on it. So with drips, it doesn't really change anything. The only thing that's going to change is where the dividends are being paid from. So if you if you have shares through a broker, the broker is going to be the ones to distribute the dividends to you appropriately, proportional to how many shares you own. So if you owned 50% of the common stock, you would get 50% of the common stock dividends. If you direct register your shares, then you will be listed as the owner. Will you ever be listed as the owner for drips? No, the broker will be. The broker will be the one that's listed on the actual ownership for that company, but everything the broker does is passed through to you. So as far as your voting rights, as far as having access to investor materials like financials, having dividends and all of that, it doesn't change depending on if you register your shares or not. The only thing that changes is the name of who owns this. So if Fidelity owned the shares and you used Fidelity as your broker, what's going to happen is Fidelity will get the dividends for all of the shares that they own, and then they will give you the piece of your dividends that you deserve. If there are company statements issued to shareholders or voting issued to shareholders of common stock, then that will be given to Fidelity, then Fidelity will give that to you. Direct registering cuts them out as the middleman, and all of those communications from the company would be going directly to you as a person. All right. So again, now the biggest thing that we were just talking about is the risk here is not so much in them lending out your shares. That's not really the problem, and that's not going to be the common thing that you're worried about, and why DRS is a thing that we should think about. What we really would think about is what happens when trading is suspended. In a past webinar, I believe it was a free webinar, not a members one, I discussed brokers and the role that they play in the market. And in that webinar, I mentioned the value of going through a reputable, large, established broker. Part of the reason is what we're about to discuss right now, and something that we saw play out with what was and still is a major broker for the stock market, Robinhood. So let's talk about what happened in 2021, and we're going to give it a name, the GameStop short squeeze. GameStop was a company that was on the decline before the pandemic, but really took a nosedive as their main business model was physical brick and mortar stores selling video games, video game accessories, game consoles, and more. Now, obviously, with the rise of online gaming, with the rise of e-tailers, the ability to buy things and trade things online, GameStop started to lose a large amount of their business and was considered by many institutions to be going the way of Blockbuster, on their way out the door. Now, as a result of this, investors will find money in the market, whether it's betting something's going to go up or also betting something's going to go down. So what they did was many institutions and many investors started shorting GameStop. They started borrowing shares and selling them to the market, hoping that in the future, when the share price goes down, they can rebuy those shares at a lower price, give them back to the person they borrowed them from, usually brokers, and turn a profit in that difference. There was so much of this going on that the short interest for GameStop back in early January was 226%, which means for every share that was available for trading of GameStop, there were 2.26 shares that were shorted. Now, I'm not going to get too far into shorting and how it works and what a I'll get into a little bit about what a short squeeze is today. But if you're interested to learn more about that, I do have a webinar from last year when all of this was going on about GameStop and the short squeeze. But I'll take a decent bit of the content from that webinar and put it here. If you don't feel like watching that, you can get the same information out of here. But again, I won't cover exactly how shorting works in this webinar. I'll just talk about why it matters. So this short interest was found out by many retail investors. Retail being people like you and me and Juan de los Palotes down the street. Individual people or small groups of investors that don't have billions of dollars to throw at investments, instead are investing with the money that they have or with a small pool of money. So retail investors, through both Twitter and a Reddit group called Wall Street Bets, found this out. They found out about the short interest on GameStop and, for one reason or another, decided that they wanted to cause a short squeeze. Really quick, to summarize what a short squeeze is. This is when buyers try and buy up shares, and instead of buying them and then selling them, like most investments, you buy and you hold. And you hold, and you hold, and you hold, and you hold, and you never sell. Now, what this does is it changes the supply and demand of those shares. And when a lot of people are buying, the demand goes up, the supply probably doesn't, because remember, the majority of the people that are trading GameStop want it to go down. So people are going to want, these retail investors started buying shares hoping that they would go up. And by buying more and more and more shares and getting a lot of people involved in this, they increase the demand for GameStop, which when demand increases and supply doesn't, price goes up. So the price of GameStop started going up and up and up. What this caused is a short squeeze, where all of the people that were shorting GameStop, they, again, are required to pay back that share at a certain point. And to make sure that they pay it back, they'll open margin accounts where the broker holds collateral to make sure that you will pay back that share. When the share price starts to go up, those institutions are going to want more money because the share price has gone up. They want to make sure that if you can never pay it back or you can never rebuy that share, they at least have the majority, if not all or more, of the price of that share. So option one, they have to put in more money, or option two, they just cut their losses right now, buy a share at whatever crazy high price it's at, and then cover their position, thus losing them a lot of money in the process. When we talk about shorting, we have to remember that the most profit you can make from a shorted sale is if the price goes to zero. You would make back everything. But the price can go up indefinitely. So how much do you serve to gain? 100%. How much do you serve to lose? Everything. So in this case, it was either you need to throw more money in because the price is going up and the institution wants to have a little bit more promise that they're not going to lose their money, you're only going to lose your money. Or an investor or an institution in this case cuts their losses, buys at this crazy high price, takes a huge loss, and I mean, as far as Reddit's concerned, this is kind of their goal. Their goal was to cause massive losses for both institutions shorting GameStop and also issuers that were providing GameStop options. Because while the short squeeze does affect shorted positions, it also affects options. Options writers will provide the right, but never the requirement, to buy or sell shares at a predetermined price. When an options writer issues an option, that option has an expiration date, so when the option ends, turns back into a pumpkin, and it's going to have the strike price, what the share price that you can buy or sell those shares at is worth. Now, I'm going to censor out the name here because I'm sure you can figure out what his name is. There was a Reddit user named Deep Something Value that posted on Reddit in early 2020 that he bought $300,000 worth of GameStop options. These options, if we see the dates, some are for April 17th, some are for July 17th, and then some are for April 16th of 2021. He noted that the price of GameStop was tanking, but he didn't think that the value that the market was giving it was correct. I don't think when he got started he realized the short squeeze that would occur. But all he knew was that he was going to see what happened. So he bought options, and then he held them. And if you notice, he bought some more options. Many of these options allow him to buy GameStop at $8, $10, $15, $17, $20, $12. Pretty small share prices. And investors thought he was crazy. Many people looked at him and, like many people on Reddit, if you ever go there, and I don't recommend you do unless you probably already go and visit there, people almost take pride in going crazy, having huge risks, and losing basically their entire portfolio value. Every other week, there's a post of someone saying, I learned how to trade with options. Here's what my return was in 2 weeks. And their portfolio dropped 99.5%. You think I'm kidding? People do this. So many people looked at what this guy was doing, DFV we'll call him, and said he's crazy. But he held. And held. And held. And this date is wrong here, but on January 27th of 2021, those options that he had purchased, due to the share price that the share was at, those options that he bought that started off, again, he did buy some more, so it's not perfectly accurate, but let's say at the high end, $500,000 worth of options. By the very end, his options were worth $48 million. Now you got to remember, the market doesn't print money. When a dollar is made in the market, a dollar is also lost in the market. $47 million came from somewhere. Where it came from was the pockets of the people who wrote those options. Large institutions that were writing these options were the ones paying the bill to the tune of $48 million. And he wasn't the only one. Many other people saw his posts and started buying options for GameStop, or just buying GameStop in general. And as a result of all of this craziness, there was a trade halt. Again, there were many brokers that had some say in this, but I'm only going to focus on the big one here, which is Robinhood. On January 28th, one of the major brokers, especially one that's commonly used by millennial investors, younger investors, Robinhood, decided to restrict investors by preventing investors from placing new buy offers for GameStop. They basically said, no one is allowed to buy shares of GameStop or these other 12 companies. The only thing you can do is put offers in to sell those shares. So what they did was they essentially said, that demand stops. That demand is going to stop. The only thing you can do is increase the supply, which of course is going to mess with the price. When no one can buy and everyone's starting to get a little antsy and they want to start selling, they're already going to turn their profit. They don't care what happens next. Of course, people are going to sell, which then increases the supply. The demand can't change. People can't put in new offers to buy. So what this caused was, well, a little bit of a disaster for both investors, but also Robinhood. Robinhood, of course, needed to have a reason for this beyond just, well, we wanted to save some money. What they quoted as the reason for this suspension was due to clearing requirements for trades. T+2 is this idea that a trade takes the day of the trade plus 2 days to settle. In that time, an investor, or rather the institution, is required to put up money to kind of back that trade until it goes through. It's the reason that if you go to Fidelity right now and you sell 1,000 shares worth of a company, those $1,000, you sell $1,000 worth of a company, those $1,000, you don't have it yet. You don't have that $1,000 yet. But the broker, out of good faith, will let you say, yeah, I've already got that $1,000. It's coming in 2 days, and go and invest with it. Because of this, there are these clearing requirements to enable things like unsettled funds trading or good faith trading. And Robinhood was no exception to that. So all of these trade offers that were going through Robinhood increased the amount of money that Robinhood had to put in these unsettled trades. So their clearing requirement, as it's called, in 3 days went from $125 million on January 25th to $1.4 billion by January 28th. This was the reason that Robinhood stated that they could no longer take new buy offers. They ran out of money to put up for these clearing requirements. But that's the answer they gave. Whether that's the answer you believe or not, or people believe or not, bit of a different story. To find the answer here, we now need to look at what happened next. Because a lot of investors started digging into things. They didn't like the fact that Robinhood messed with the market. They prevented buyers from buying, and they only allowed people to sell. Now, again, the answer that Robinhood gave on paper makes sense. But many retail investors believe that there was more to the story, and that Robinhood didn't stop trading because of these deposit requirements. Instead, they suspended trading to protect losses from major hedge funds that were heavily involved with Robinhood and were massive shorters of GameStop. One of the most common names, there was two. One was Melvin Capital, and then the other was Citadel. Looking only at Citadel, Citadel made up more than half of the trade volume for Robinhood. So what happens if you're Robinhood and the person that does 50% of your trade volume comes to you and says, hey, we're losing billions of dollars, do something about it? If you ask Reddit or if you ask Twitter, they're going to tell you that Citadel told Robinhood to put this suspension for trading in place to save them money. The internet didn't like that. Whether it's true or not, I'm not going to sit here and tell you if it's true or not. It's not for me to decide. But the trade suspension did happen. That was something that happened. And a lot of investors didn't like the fact that, like that, their ability to trade in a free market was taken away. So now, after all of this explanation, let's talk about DRS. DRS is a service that allows an investor to transfer ownership and management of their shares from the institution directly to that shareholder through your name and or address. This process is meant to be as close as we can get to physical certification or physical ownership of a stock using the internet. And in fact, actually has some benefits over the internet or over physical sheets of certificates. Namely, you can't really lose or accidentally burn or have your dog eat a digital certification. Sorry, Fido. No breakfast for you this morning. So DRS is meant to be the closest thing we can get to these old style physical ownership receipts using the internet. As a shareholder of these DRS shares, you are reported as the shareholder on the registry of all the shareholders for that company that is managed through their transfer agent. And as a direct shareholder, all dividends, all company statements, all company voting matters, these are all mailed directly to you, not your broker who then gives them to you. Again, let's go look at that chart now in a little bit more detail and talk about how this kind of takes some of the layers of insulation away from us. So again, these shares will be owned by you, technically, but they're managed through your broker, who then has an overseeing DTC nominee, and then that is what's put on the list of all of the company or of all the shareholders. It's not your name, it's the DTC nominee for Fidelity. So again, you are not listed as an owner, but you can be listed as an owner if you decide to direct register your shares. And you would do this through the transfer agent. That same group that manages all of the shareholder relations for the company is also the one that would direct register the shares for you. So let's talk a little bit more now about the impact that DRS has. And to do that, we need to talk about shares float. These shares float refer to the number of shares that are available for investors to purchase. Things that can be bought and sold right now. Now, these shares, yes, are the number of shares that can be bought and sold, but can also be the number of shares that can be shorted and then some. Again, in our other short squeeze webinar, we talk about how one share of a company can become 2.26 shares that are shorted, or short interest shares. We're not going to get into that today, but what I do want to get into is the supply and demand part of this. Because this is where the argument for DRS and the recent popularity of DRS comes from. If institutions, or in this case, we'll just use the word investors, are shorting GameStop, there is a supply and a demand for the share. If the supply goes down, then the price is going to go up. So one way that you can make the only real way that you can make the supply of shares float go down is by direct registering them. When you direct register a share, you are now the owner of it. And if you're not selling it, then no one can short it. You own that share personally. Fidelity doesn't own that share. Robinhood doesn't own that share. You own that share. So as more and more investors direct registered their shares, the supply of shares of GameStop went down. As a result of that, the price should go up. If the price goes up, then some short investors or investors that hold short positions are going to want to get out. They are seeing the price go up and they want to cut their losses right now, so they will buy shares to try and cover their shorts. But because a lot of people are buying and holding and using DRS as their proof of, look, I'm holding, I'm not selling, this increases demand because now more and more investors want to cut their losses and get out. So as more people want to try and sell, or I guess in this case, buy to cover their short positions, more demand, lower supply, even higher price. So if I'm the owner, the broker cannot negotiate that share, only me, correct. If you are the owner, if you direct register a share, the broker is completely out of this. That share is no longer in your brokerage account. They remove it from your brokerage account and instead you directly own that share. Which also gives you the responsibility of, if you want to sell that share, having to go through a few extra steps to actually sell it. You don't just go to the market or you don't go to the broker and say, hey, go sell those for me. You would need to do that through the transfer agent, or in some very, very small cases through the company itself. So where we're left here is the knowledge that direct registering doesn't really change anything, but it's commitment to, I'm holding, I'm buying this and I have no intention of selling it. I'm removing this from the amount of shares that can be bought and sold by institutions. That decreased supply, if enough people do it, will actually make a difference of the number of shares that are available for lending and borrowing, but also trading. Lower supply, higher demand, bigger change in price. The more the price goes up, the more short positions are going to want to cover and get out, which only increases the demand even more. And the supply, if it's not changing, will send the price even higher. As of August of 2022, just about 77.5 million shares of the around 250 million shares float, 305 million shares outstanding of GameStop have been direct registered to investors. Now, let's answer this question, or get close to an answer for this question. Should you DRS your shares? Should you go through the process of direct registering your shares? Well, I can't really answer that for you. But let me give you some information to help you make the right decision for you. The majority of the reasons for doing this are not logical. There is a reason because it makes me more money. It is not a reason because it's safer. There is very low risk in a normal market for you to need to do this. There's no real market risk that pushes you to DRS or to go through the process of DRSing shares. Instead, the main reason that people are doing this right now, and yes, again, this did happen in 2021. If you direct registered your shares, you would be able to circumvent, you'd be able to get around Robinhood and sell them or buy new ones. If you, well, you'd kind of already have to own one, so you need to find a broker that's still trading them. But again, the big argument here for DRS is not in this will save you money. It's we want to get back at institutions. A lot of the current millennial movement around investing is this idea that institutions suck. They use the system against us. When there's money, there's power. And when there's power, when someone has power, someone else doesn't. And the people that don't are usually people like you, me, and Juan de los Parotes. The argument for DRS is to get back at these financial institutions, remove some of their power and give the power back to individual investors. Are hedge funds still shorting GameStop? There's still about 30% short interest on GameStop. So yeah, there still are a lot of people that are shorting GameStop. So the first argument here is that investors just want to get back at institutions. They want to try and take some of the money away and make them realize that the little guys still have a lot of power, especially when the little guys group up and work together towards something. And the second is going to use a term from this entire GameStop community. There are two groups. There are the paper hands, the people that they buy and the minute it starts going down, they sell, they panic. Then there's the people that are diamond hands. It can go up $1 million, it can go down to zero, and every little possibility in between. They are not selling. They will hold until the very end. What that very end is, I have no idea. Gotta ask them. But they're gonna sell, or sorry, they're gonna hold. They're not going to sell. They're going to keep holding, and then when they think they've held enough, they're going to hold a little bit longer. By going through the DRS process, this shows their dedication to that. It proves to them and also other people on the internet, because proving yourself to other people on the internet matters, that you're in it for the long haul, that you are proving, I own this, I'm proud to own this, and it's not going anywhere. Again, while selling a share that's DRS'd is not impossible, it, funny enough, has actually become very quick, almost as quick as a normal broker. It used to take a significant more time for a trade to go through because you would need to wait for that transfer agent to lump a bunch of shares together and then sell that lot of shares at a specified interval, be it once a day, once a week, once a month, and so on and so forth. There's a lot more steps to it, and there's a lot more you involvement in it. And that was okay, because the reasoning behind it, people cared more about the movement. When it comes to the current attention around DRS, this is not a conversation of this is insurance. This is not a conversation of this is the right thing to do for your finances. It's a moral movement. It is this idea that right now, big institutions and the financial titans have too much power. Let's take some of that power back using the tools we have available to us. DRS is one of those tools. So DRS and the attention around it right now is not a financial incentive. It is a movement. And it is, if you want to support that movement, you can choose to DRS your shares and help take a little bit of power away from these institutions and brokers. Now again, the biggest argument against DRS here, and this again becomes a little bit less important every single day, thankfully, due to movements like this, I hope that by me saying everything I'm saying, this is not saying that Reddit and Twitter are the bad guys here. There is a lot of merit and a lot of importance for giving investors more power. The fact that brokers have as much power and say over the market as they do is challenging. And the fact that we are not the big fish. I remember one example my mom always used of investing when I was younger was we have a swimming pool or a bathtub. Let's say a bathtub. We are a rubber duck. We don't really make too much of a splash. What does make a big splash are the hippos, those institutions. All we want to do as investors is be in the right tub for when the hippo gets in and raises the water level up, bringing us along with him. These retail investors want to change that. They want to try and make the hippo go on a little bit of a diet, slim down, and not give them as much power, and instead take some of that power back. Because in the modern era, investing has become a lot more accessible. Why should we still be using an old standard of institutions holding the power and making the decisions for us, and us just being little rubber ducks? What if we started to be able to cause a splash too? Because one small little rubber duck is not really going to do very much. Want to know what might do something? Let me grab a picture for y'all. How about if this was our rubber duck? Because that is a little bit bigger than a hippo. All it took was a lot of inflating. This is what Reddit and Twitter wants us to become. This is the rubber duck they want us to be. They want us to be bigger than the hippos because we worked together to make a pretty darn big duck. So again, as more and more people DRS their shares, it brings attention to the movement and also lowers the barrier to entry. As DRS becomes more popular, the barriers to get started with DRS are going to become easier and easier. And the reasons not to DRS, such as longer times to actually sell your shares, are going to go down and down, as we have already seen them do in the past few years. So, should you DRS your shares? Hopefully now you know a little bit more of why you might want to, some of the reasons why you might not want to, but also understand the context behind why this has become such a big topic in the past few years. Or not just past few years, in the past year. Now I'll let you make your own decision. So, thank you all for joining us for this webinar. If you have made it this far into the webinar, please give either the live stream or the video a like. Contribute your thoughts to the chat or to the comments. It's always a pleasure to get to see the conversation you all have, sharing any insight you might have. And if there is an idea or topic that you want to hear us cover in a future webinar, you can always send us an email at support@sectorsmadesimple.com. And your idea of wanting to know a little bit more about the apes of Reddit and the DRSs of the stock market world can become a webinar topic in the future. So thank you all so much. Have a great weekend, and we'll see you all very, very soon.